Welcome to Independent Living Bullion's weekly market wrap podcast, helping precious metals investors during these treacherous times. And now, here's this week's market wrap with commentary and analysis from the fastest growing precious metals dealer in America, Independent Living Bullion.
Welcome to this week's Market Wrap podcast. I'm Mike Gleason. Today we welcome back our friend and colleague David Morgan, editor of the renowned Money, Metals, and Mining newsletter, to get his take on some interesting market action in the precious metal sectors these days. David, thanks for joining us again.
My pleasure. Thank you.
I've got a number of things I want to cover with you today, but I want to start out with getting your thoughts on the recent move we're seeing here. As of this interview, silver's advanced some $2 in about a week's time. So what do you make of this, David? Because generally we don't see significant advances during these summer doldrum periods, generally speaking, of course. So do you think this is a false breakout, or do we finally have the makings of a much anticipated reversal to what has been kind of a rough year for gold and silver overall?
Well, rough 2 years, actually, as you know, Mike, and especially since silver broke down below 26 and gold below the 1550 level. No, I think this is it. For my paid membership, I put out a buy signal recently, and we have a seasonality that has an 85% accuracy that I also gave to our members, and that's a seasonality trade, again, with an 85% accuracy. So I think it is a time, the best time to buy gold is normally in August, and the best time to buy silver is usually July or August. So this is probably a good opportunity. Again, to repeat your question, is this is this it, or is this kind of a false breakout? This is at least a tradable rally, and for me to be a tradable rally, I want to see a 20% move in the underlying commodity. So for silver, let's say it broke out at 20. 10% move is $2, it's 20% move is $4. So I'm looking for like 20 to 24 as a minimum. I don't think we're going to get, right up to 26 right away. I am still forecasting the 26 level by the end of the year. So I expect to get a good tradable rally here, and then probably a pullback, probably not to the low that we saw when I called the bottom. I didn't do it on that day, although I alluded to it, but I did call it about a week or two later, and that was a key reversal on the 28th of June. And all of July we consolidated around the 1950 level, and as you well know, we have broken above that substantially now, and silver's showing good strength. But yeah, this is the real deal. Is there still time to get on? Absolutely. I mean, I'm going to stick to what I said probably a year ago. If you can buy under 30, do it. Well, obviously we got under 20 for a small amount of time. But long term, buying at 30, and I know there's a lot out there probably that bought at 30, probably bought from ILB, and they're not happy because we're just, $22 level right now. But I think if you go out 4 or 5 years and you can tell your friends and colleagues if you bought silver at 30, you will be very happy to announce that price from the aspect of where we're going to be, again, 4 or 5 years out.
We had you on right after that reversal you mentioned there in late June. I remember you talking about that and definitely nailed it. That was kind of a key point. I mean, we went sideways there for the better part of July, but yeah, it looks like we could be seeing some good action here going forward. So kind of expanding on that, talk about some of the key indicators that you look for when you're sizing up a rally in the metals. I've heard some people say they want to see silver leading the way. Others say the movement in the mining stocks is a good indicator and what you really need to look at for whether the breakout can be confirmed or not. But what kind of things do you look for in your analysis? Because you obviously follow this as close as just about anyone and have been for a long time, so I know you've seen it all.
Well, I've pretty much seen it all. It's probably one or two things I haven't. But I certainly, with over 4 decades in this market and studying technical work and fundamentals and all that goes with it, I've simplified things a great deal. I mean, if you want to get started in technical work, I would say anything by John Murphy. Read it, buy it, and read it. He's the founder of StockCharts.com. That's one of the services I use, and the one I use the most often when I do my membership updates. But for example, one of the favorites is the MACD. And if you go to like Wikipedia and look it up, it's based on historical data. And it's a moving average. It's either converging, diverging moving average, and it has some merit. But basically what I've learned, again, is to simplify. So Specifically, I like to see, one, the mining shares leading, but that's not an absolute, but that's normally what happens. I like to see the mining shares outperform at about a 3-to-1 ratio. In other words, gold was up 1% as we're doing this interview, and the one of the main indexes is up about 4%. That's a 4-to-1 ratio. I don't have to see it every day, but I like to see that. In other words, the shares are starting to finally respond to higher metals prices. Another thing is silver leading. That I like to see, not necessarily leading by price action. In other words, silver is making new highs before gold makes new highs, although that is a factor, but leading as far as, again, percentage gains. So if gold is up on a nice rally, let's say it's up 2% for the day, I like to see silver up like double that, so it'd be like 4% for the day. And I also like to see follow-through. I mean, one day doesn't make a market. I'm sure people are sick of me saying that, but it's also something that bears repeating because people seem to buy at the wrong time. They seem to buy not when the market's quiet, when no one's paying attention, when it's rallying strongly and it's rallying 4 or 5 days in a row, then they start getting excited and then buy only to see it fall off for 3 more days or something. But I like to see follow-through. So I like to see volume, price, and consistency, meaning like a 3-day, I have a 3-day rule. I call it, again, I explain it to my members. I'm not always consistent on it, but it's a good way to keep you out of trouble because sometimes, again, if you chase a market, it can fall off as quickly as it went up. So all these things are taking place in the silver and gold markets right now. The shares are confirming the move. The one thing that's happening is a pretty strong rally so far. We've got to see how far it goes. But the one thing that no one seems to expect is a strong rally in a short period of time. Most of my colleagues, and I won't name names, are of the mindset that we've got like another 2 years to consolidate. That may be true. I mean, it's way too early. I mean, we've gone from 1830 up to 22 and change in a very fairly small amount of time. But maybe it will drift sideways for another several months. I doubt it highly. But nonetheless, it could be the case. Again, to just repeat one more time, what no one expects is a really strong rally that really, really goes. In other words, even I'd be surprised, for example, if this rally continued past the $26 level and busted through like a couple real big resistance levels, like 30 is a round number, and then 33, which had a lot of action on the buy side, which would be resistance on the way back through. If that were to take place, I'd be very happy. It'd be wonderful. I don't expect that. It's not usually how markets move. But then in today's world, with all that's going on and the small amount of precious metals that are out there, and the word precious means precious. There's much of it. I'm not talking about the derivatives market where you can create it to infinity. I'm talking about the real deal. Since it's so precious that, could take place. I don't, again, forecast that or see that. But nonetheless, no one, including myself, is really expecting anything along those lines.
As we always say, it's very difficult to predict, what happens in the short term, and really it's anybody's guess. But just encourage people to continue to look at the fundamental picture, which of course is still very sound and everything's still in place for, bull market to continue forward. One of the topics at the forefront right now is the backwardation in the gold market. First off, please give our listeners kind of a layman's definition, if you would, of exactly what backwardation is, because I know it can be a little confusing and perhaps a little bit of an inside baseball type of term. And then also talk about why it matters and what your take is on the situation. I know some think it's a major deal, but perhaps you've got a slightly different take.
Sure. Backwardation is where the spot month or the near month or the contract month, in other words, whatever month you're living in, which would be August in this example, is trading at a price above the next futures month. So September or October, depending on the commodity. Sometimes there's not a delivery month. So the further out you go, the more you pay for a commodity, and that's called contango. And that's normal because it has to do with the price of the commodity and then the interest rate of carrying the commodity, and the interest rate is almost always coincides with the LIBOR rate or the normal bank rate that you're going to get your normal interest rate. So, when interest rates are very high, for example, any commodity that you carry for a year, and the normal interest rate was say 10%, which we're at 0% for all purposes now, Backwardation is where you have to pay more. So, for example, I just called my futures broker because you're going to ask me this question, just to, quadruple check this. And I asked him, are we in backwardation? And he said, yeah, we are. We're in about a 20-cent backwardation right now. The spot month is 20 cents greater than the October month in gold. Okay? So that is technically backwardation, but that's almost preposterous because 20 cents really doesn't mean much at all. I am on the other side. This happens about every 2 years or so. I went through this a couple of years ago, and some of these people that are on this huge bandwagon about backwardation are really good friends of mine. But nonetheless, backwardation in commodity where it's significant is when there's a significant price delta or price change or price differential. So for an example, if the spot gold right now is at $13.36. So let's say that the price of gold today to buy it from the commodities exchange was $1,400, and the October contract was $13.38. Now you've got significant. That means something significant. What that means is that whoever needs that gold needs it now, doesn't want to wait, and is willing to pay a greater price to have it today than to wait a month or two out. That does take place. It's taken place in almost every commodity. It usually lasts about 2 or 3 days, and then it corrects. So for an example, if you were in silver might be a better example because it's used more in the industry than gold is. You're going to delay your production line if you can get silver in your production line pronto. Well, someone that's running a factory like Mitsubishi or Ford Motor or Dow Chemical or DuPont or any of the big silver users, for example, would be willing to pay high to get it now. And that's significant, and again, it usually lasts just a couple of days. So that's when it has significance. This, interest rate spread and how it, if it's not in contango and you can play these interest rate games, all that is basically derivative interest rate swaps and that type of thing. It really doesn't have anything to do with the gold market. These guys are making a big deal out of it. Let them do that. Let them explain it. But in the real world that I live in, I'm talking about the real commodity, and when you need the real metal and you need it now, you're going to pay significantly higher. That's backwardation, and that is significant, and we're not there. This stuff that they're talking about is a bunch of interest rate swaps and this kind of thing, and it really means nothing in my book. Really means nothing.
A potentially big story right now involves India and what they're doing to restrict gold bullion ownership over there by imposing draconian-type taxes and so forth. What do you make of this, and what do you think the impact will be, not just on the supply of physical gold and the price of gold, but also what effect will it have on silver? Will this result in India becoming a major player in the physical silver market, because it's well documented how much gold that country consumes?
Well, a couple things. One is what impact will have on gold. Usually whenever you restrict something, you get more of a demand for it. So it's not really going to quell the demand, so you're going to have more of a black market / free market / gray market in gold, and there'll probably be more entrepreneurial types that will come into the market and take the risk of smuggling it or buying it from somewhere and bringing it in and that type of thing. So it's really not going to quell the demand, although it could certainly slow it down, because a lot of people will just walk away and say, I'm not going to pay that kind of a fee to be able to buy gold. So there will be several leaving the market, but nonetheless it will continue. What we'll do for the silver market, Sprott Asset Management already wrote an article that I thought was very good, and their theory, and I agree with them, was that, if you can't buy gold, we'll buy silver. The part that kind of annoys me, but since I'm, one of the big silver bugs around, is what it used to be like. I mean, if you go back into my history, looking at, India, they were too poor to buy gold as on a citizen by citizen basis, but they bought silver. And silver was the big thing. In fact, there was a big joke around during the Hunt debacle that it was Bunker Hunt versus a billion Indians. They were talking about Indians from India, and that they had all this, massive amount of silver, and they do. but they're not net sellers. There's very little exported silver out of India. But it used to be silver, and it wasn't until probably the last decade or approximately that time frame where they didn't really switch to gold, but they had the ability, due to higher income rates, to be able to afford gold or afford it more readily. They've always wanted gold. I don't want to misrepresent this, but they just didn't have the ability to buy it in the quantity that they can now. So silver's really been kind of the fundamental precious metal for India for most of their economic history. Regardless of whether it's silver or gold, they are very astute on, the rupee and what happens to their currencies through history. So they are big savers in metal, not so big savers in currency. They understand the hows and the whys of that. And so what will affect what we'll have going forward? I think it will probably swing things more to the silver side again than we have seen for quite some time, where gold has kind of been favored. But I think it will move back into the silver realm.
There certainly are seemingly a lot of tailwinds right now, in the precious metals market. So it's going to be, an interesting next few months. Do you expect this rally to last into the fall? I know you kind of hit on that a little bit earlier. Do you think we're going to continue to see a strong second half of the year?
Yeah, I do. I think that we'll see a good rally here, as I said. Probably some kind of falling off. Again, I'm going to stick to my $26 by year end. The problem I've made the last couple of years, and it's based on seasonality, and last year I really didn't have an excuse. I should have just sucked it up and put out a kind of a last minute forecast, because I really thought what we don't normally get going to the end of the year is a pretty good move, at least sideways, but not down. But the last couple of years we've had these big sell-offs right through the last trading day of the year. And that's easy to orchestrate because there's so little trading volume. You don't have to do much paper selling to get it to move down. And so this year I'm kind of prepared for that happening. But regardless, I think we're going to get to the 26 level before, by year's end, which doesn't mean the last trading day. We could hit 26 in, let's say, November, only to watch it fall off to like 24 by the last trading day of the year. I just don't know yet. A lot still depends on the physical market. A great deal depends on the paper markets. But these paper markets are being less and less trusted all the time. And gold's really the driver there. It's not silver, although it could be. From my work and what I've looked at and the studies that we do here, gold's being drained from the COMEX rather significantly. And the amount of gold in the COMEX is absolutely pathetically small. I mean, pitifully small. So it wouldn't take much to continue to put pressure on COMEX gold supplies to at least wake up some people to the fact that, this area of paper derivatives trading is just that. It's paper, it's a derivative, and it's not real gold. And whether or not that will take place or not remains to be seen, but the trend is clearly in place. So because of that, it's really hard, Mike, to say, well, it's going to this or it's going to that, because I think we really need to pay attention to what's happening there. But I do want to say this. I think the worst is behind us. I think the bottom is in. I think you can still dollar cost average from here on out. I think if you bought higher, I know there's a lot of your listeners that have, a lot of my members have, don't give up, and don't sell back too soon. We are going to have to work, again, the overhead resistance levels, and you can look at a chart and understand what those are. If you don't want to do technical work, that's fine. Just realize that, we held above the $26 level for a very long time on silver, and we held above the $15.50 level on gold for a very long time. And then when they broke down, it's just been the last few months, a lot of people have given up hope, but they shouldn't. And also that once we get back through those levels and they become support again, that we'll have to work our way higher. And there's a lot of what's called stale bulls, and a stale bull is somebody that bought 2 years ago and bought silver, as an example, at 40 on the way to 48 in 2011 early, and it's just been very painful for them. And so when it gets to that level or near it, they might sell out and think, I've broken even. I got my, my currency back. I didn't lose. I bought at 40. I sold at 40, and I'm happy to be out. So there's that kind of mentality that goes on in all markets. It can happen with a stock, a commodity, limited partnership. I mean, all kinds of investments where people buy them, they go down, and then they do come back and they sell them. But I don't expect this thing to get whipping up hugely this year, of course. In 2014, I do think we'll just have to wait and see what the volumes are like. But I think that will be more people coming into this year's idea, which is the transition year.
Well, it'll certainly be interesting and hopefully exciting during the back half of the year and on to 2014 as well. Strong move would certainly be a welcome sight to many for sure. Well, David, thanks as always. Before we let you go, talk about your membership service. You mentioned it earlier, and tell people about what they get for signing up for that.
Well, you bet. First of all, I do give a lot. I love the role of, being an educator, and I've done that for, my career since I've been on the internet. I go to a lot of these, conferences, and like to meet people and teach and that type of thing. So there is a free report that comes out weekly. You can just get on the website and sign up for free, and it is free. But the way we make our living is through the Morgan Report. There's 3 levels of service there, but the mid-service, which is the basic plus service, has some benefits, several, but one I'll outline is that the benefit of that level of service is you get to email us. And you can email us basically any question you want, and you will get an answer. We guarantee that. So, you might not want to, do a consultation, but you have a specific, question, like, I just don't understand why da-da-da-da-da-da, and you can email that in, and again, we do guarantee questions. So, that's kind of the trigger point for some people. It's like, well, I'm going to get this, and this, but, I really don't want to subscribe. It's, X amount of dollars a year. But then when they hear that they have the ability to just send us an email, there's a little box form on the membership only part of the website, and just type in your question, send it to us, and either I answer it personally or send it to one of my staff, but you will get an answer. So I thought I'd point that out. Thank you.
Certainly. Well, we always appreciate your insights, and thanks for being so generous with your time once again. So enjoy the weekend, and we look forward to catching up with you again real soon.
Thank you, Mike.
Well, that will wrap it up for this week. Don't forget to tune in next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Independent Living Bullion. Thanks for listening, and have a great weekend, everybody.